Buy, Borrow, Die is a wealth building strategy, but also a tax minimization strategy. And in today's video, I'm going to show you how using this strategy will keep more wealth and net worth on your side of the financial balance sheet and less money going to the IRS. I'm Matt Sorensen. Let's build wealth. All right, now there's three components to this: buy, borrow, die. Now the detail is really in the borrow context, so I'm going to focus most of the time there. Let's talk about buying assets though. So as we're talking about building wealth, earning money, and then investing that money, we want to invest it in assets that appreciate over time and that derive income. Those are critical because I can get debt and borrow against those assets, which we're going to come to here in a second. The typical assets we're talking about here is investment real estate. This could also be your personal residence though. We're also talking about stock portfolios, market publicly traded securities that appreciate in value and also could have dividend income. This could also be private small business investments, or maybe even a small business you own or are a partner in. Now, this strategy is so effective, the Democrats in Congress have introduced a bill to try and stop it. But whether you're Jeff Bezos or Warren Buffett or Donald Trump, the people in the news who have been using this strategy, or you're someone with your own little sliver of $1 million here, you can use this strategy to help you better build wealth and save taxes along the way. All right, now let's get to the borrow component of the build, borrow, die. The borrow component is pretty straightforward. It essentially is stripping out the equity of the assets you've accumulated. This could be investment real estate. This could be a brokerage account with publicly traded stocks, but we are going to take a loan against those assets from a bank. And I'm going to get to the costs of that and the benefits, but you're going to pay interest back to the bank and then have that value of the loan to then use for personal expenses and living, rather than selling the asset and taking proceeds of the asset and living off of the proceeds from the sale of the asset. The point here is we want to keep assets that can appreciate in value and that are going to provide additional income over time. That appreciation in value and the income generated is enough, typically, you got to be doing the strategy right, to pay for the cost of borrowing. But also, when I borrow against assets, whether it's real estate or whether it's a stock portfolio, I don't pay any tax, even though that asset may have gone up in value. And even though I'm taking out that appreciation in value and benefiting from it personally, I'm not paying tax when I take out debt against it. If I sold the asset, the appreciated rental property, the appreciated stock in my brokerage account, I'm going to pay tax on that. And that's going to come at long-term capital gains rate plus whatever state I'm in. Maybe I get to keep 75% of the proceeds. I certainly don't get 100%. But when I take a loan, I get to take 100% of that debt. Now there's a cost to the debt to the bank. We're going to go over the numbers here in a second. But that's the principle here. I want to keep assets that appreciate over time and can produce income. I want to pay no tax as I'm accessing that value in the assets. And then over time, what am I going to have? I'm going to have some debt on my balance sheet when we're thinking about my net worth. But what do I also have? I still own the asset and it's still appreciating in value and it's still producing income. And that is more valuable because I have a greater net worth at the end of the day, but I had the opportunity to take advantage of the net worth and appreciation I built up in building these assets over time. All right, now let's look at an example here of a stock portfolio. Now this is from JP Morgan here, JP Morgan Private Bank, and it goes over someone with a $10 million stock portfolio that needs $3 million to live on or for other personal expenses. Now it's going to go over the example here of selling $3 million of stock and then using that money versus taking a loan of $3 million against the $10 million stock portfolio. So here let's go over scenario A of the client that says, I'm just going to sell $3 million of stock. Okay, well, what happens there? Well, the first thing that happens is they only have $7 million invested in growing now. They don't have growth on $10 million. They've only got growth on $7 million. That's the first problem because your net worth has gone down. You have the ability to improve assets in your net worth from the appreciation and income off of this stock portfolio. Not when you sell it though. The second thing that happens here is you're going to have tax on that $3 million. Let's say 2/3 of that is capital gain, $2 million at 25% between state and federal taxes. I mean, you're going to have a $500,000 tax bill on the $2 million gain. So you really didn't get $3 million. You only got $2.5 million. But also what this is showing here is the wealth building problem of selling assets that can appreciate over time. Now your portfolio over the next year is only going to deliver $483,000 of return, and your net portfolio then is going to be $7,483,000 at the end of the day. However, if you were like smart client B here in their example, and you had that $10 million portfolio, you did not sell, but you instead got a loan from the bank for $3 million, you would still have a $690,000 return. They're assuming a 6.9% return return in both examples here being very conservative. But they're also saying, but you are going to have loan costs to us. You got to pay us the bank for this loan. And on that $3 million loan, you're going to be paying $58,000 in interest. Well, what's the benefit? The benefit is I got another $3 million to stay invested. And even after paying the interest expense on the loan, I now have a return of $631,000 instead of $483,000. So the benefit is huge here, and it comes out to a $150,000 difference at the end of the day. You are $150,000 wealthier by taking a loan against the asset rather than liquidating and selling the stock. Now, the reason I like buy, borrow, die is because of the borrow part. The die part's not so fun. We're going to get to that in a second, but it is a great tax strategy for your heirs. But the borrow part is nice because we want to accumulate assets, again, that appreciate in value and that produce income. But I also want a benefit of those assets. As my net worth is building and I'm putting all of this hard work in my career or in your business, whatever it may be, I want to have the benefit and the enjoyment of those assets over time. But I want to be strategic about it. I want to still keep my wealth in those assets, and I want to pay as little tax as possible. That's why the buy borrow strategy is so popular. The die here is not so much, but we're all going to die one day. So we'll get to that here in a second. But now let's get into some details here on how those loans work against the stock portfolio. All right, now how do you get a loan against your brokerage account? I'm going to break this down. This is typically called security-based borrowing because your securities, your stocks and mutual funds, ETFs, those are securities. And mostly the broker dealers like to do these loans. The banks like a JP Morgan or a Wells Fargo here. I got Wells Fargo here as an example because they go over their loan terms on this. Now, you don't have to be someone with hundreds of millions, tens of millions, even millions of dollars. This works for a loan amount at a minimum of $75,000. You really need to have a brokerage portfolio of at least $150,000 where you can draw out some of the equity here to do this. All right, let's go over the loan terms here. Okay, minimum loan amount of $75,000. The next thing is, what's the debt to equity? What is the amount of debt they'll make me take out based on the value of my account? Well, it varies from 50 to 90%, depending on your situation and the assets in your brokerage account. So they might lend you half the value. So let's say you need a $75,000 loan. You must have at least a $150,000 brokerage account with publicly traded stocks. But it could go as high as 90%. Now, the average I typically see is around 70 to 75% that most banks are going to provide a loan against a publicly traded brokerage account. So if you had $1 million brokerage account, rather than selling assets to go live off of, let's instead get a loan against it, which you could get up to $700K. All right, now here's the critical point here. There is a cost to the debt. You're going to be paying the bank interest for this loan. But if the rate of return I can get of the asset appreciating over time, plus any income from it, can outperform the cost of the debt, I'm ahead and I'm building wealth while still getting access to the cash and the value of my brokerage account or other asset here. This can work for real estate. We're going to hit that here in a second. But I'm getting the value out of that and paying no tax along the way. So how do I access that and what is the rate? All right, so we get the loan out. Let's say you took $200,000 against your $1 million brokerage account. Now, the rates right now on a brokerage account are based on what's called SOFR, S-O-F-R. That's a variable rate that can shift over time. But let's say here it's SOFR plus 2. SOFR right now is 4.3%. Plus 2, that gives us a 6.3% interest rate. Now, this is just interest only. You typically be paying down some principal over time, but just so we can do a quick comparison of the cost of the debt here versus your asset staying invested and appreciating. So at 6.3% of $200,000, that's $12,600 of interest cost you're going to have each year on that loan. However, if I let that $200K stay invested, which you're going to do here when you take out a loan, it still stays invested. And let's say it goes up 10% over time. S&P 500 has gone up over 10% over the last 20 to 30 years. So I'm up actually $20,000 and I'm net ahead $7,400. Okay, so I'm ahead here. I got a loan on the money. What I'm paying the bank is less than how the asset appreciates over time. I paid no tax when I sold the asset. The debt comes out to me as money I can use for whatever I want. No taxes, I draw the wealth out of it. So this is the build, borrow, die strategy in its essence. The principle here is the cost of the debt being lower than the value and appreciation you can have in the asset itself because you get to keep it. Plus the kicker of no tax when you take a loan against the asset versus tax when you sell the asset. Now the principle works the same here for investment real estate that it did for the brokerage account. account. Let those investment properties appreciate over time, continue to provide cash flow, but don't sell them. Stop selling appreciating assets. Let's build wealth and accumulate assets. If I want to draw out the wealth and enjoy it, take a loan against the asset. I only want to sell assets that are not going to appreciate and that don't produce income. So for your investment real estate here, we want to access the equity in those properties. You can typically do a cash out refi on the properties up to 75% of the loan to value. So if I got $1 million real estate portfolio of equity there, I can take out $750,000 of that equity to use for my enjoyment, and I'm paying no tax as I access that equity, rather than again selling the property, paying capital gains tax, and paying state income tax. So this keeps more money in my pocket, more net worth on my balance sheet as I'm trying to grow and build wealth. Now the scenario shifts a little bit here when we think about your home. And maybe you're aging and you're thinking about later in life, you may have a large home or something like that. Maybe you can downsize. A lot of people think, well, I'm going to sell the home because I can get the sell of home exemption. And that's true. For your home and your residence, there's a couple other considerations here than there is for investment real estate. One, it's a place where you live. Okay, there's a certain cost to that. So selling the house means you pick up a cost of rent somewhere else. The other thing a lot of people ask is, but Matt, when I sell the house, I get the sell of home exemption. I can exclude up to $500,000 of gain in the sale of my home if I'm married, $250K if I'm single. So the tax benefit isn't as big. True, this is a home you've owned for 10 or 20 years. You might have a gain larger than that, but there's still a pretty significant sell of home exemption. So we got to keep that into account here. What I like to think about is, how do I get the best of both worlds on the home? One thing I like to think about is not selling it. Maybe you do need to downsize the home, but that home is actually in a good rental market. If that's the case, the state where you live in, the city you live in, if your home could turn into a good rental property, has good cash flow, good yield based on the value of the property, don't sell it, turn it into a rental, and then draw out the equity. Now, I know a lot of people say, but Matt, I could sell it and get the sell of home exemption. Yeah, but you lose the asset. And I know the sell of home exemption can be tempting, but if you've already got a loan on the property and a bunch of equity in it, let's let that continue to ride. If you live in a state that's a good rental property state, turn it into a rental, continue to produce income on it, get the appreciation over time, and be able to tap into that equity using a cash out refi. Now, you may live in a state like California where the property values are high and the rent costs are low in comparison, and it's not a good rental market. And in that case, I might say, do the sell of home exemption. But what I want you to think about here is, how do I keep assets on the balance sheet? Let them appreciate and use this build borrow strategy to draw out the wealth that I can enjoy and live on in my later years. Now, the numbers on the real estate's the exact same I showed you on the brokerage account. What's the interest rate I'm paying versus what's the appreciation value of the property? Now, real estate has appreciated about 4.6% per year across the US nationwide for the last 30 years. That's just the average. Now, that is on the cash invested. Remember, when you own real estate, you might own a property for $1 million and $500K is equity, but the other $500K is debt. The nice thing about the real estate is I'm getting 4.6% on both. So if I'm looking at just the rate of return I'm getting for my equity or otherwise cash investment, that 4.6% is actually doubled. So in other words, on the real estate example here, when we're looking at this example, I'd be looking to get a rate of return of about 9.2%. So as long as my cost of debt is less than that, I'm winning on my balance sheet and the net worth as I'm building wealth, even before we take into the tax considerations. Now, of course, the investment real estate, you're gonna have tax when you sell a property, but your personal residence, there could be a sell of home exemption. Let's consider whether it makes sense to keep that as a rental property or not, depending on the state where you're at. All right, now let's get to the die part in the strategy here. This isn't the fun part, but it is part of the strategy here, and it's a great tax benefit to your family as they inherit the property. Rather than selling the asset and paying tax, again, we're gonna strip out the equity of the assets, use that wealth to live on and benefit from in our later years. But when I die, as I pass on the asset to my heirs, they get what's called a step up in basis. What that means is, let's say that I bought the property for $100,000, or I bought some stock for $100,000, and now it's worth $1 million. But rather than selling that, I took out a loan on this real estate or this stock of $700K. So I've got $700,000 in debt. If I would have sold that $1 million, and I bought it for $100K, I would have had a $900,000 capital gain if I sold it. So I didn't. I understood this appreciating assets that can produce income. I want to keep those. videos, I'm going to strip out equity and do the buy borrow strategy. But here's where the die comes in. So I had a $900,000 of appreciation that if I sell it, it'll be a capital gain. When my heirs inherit that for $1 million, they get a basis in the property of $1 million. They don't get my original basis of what I bought it for of $100,000. They get a step up in basis, which means they can sell the property the day after I die and pay zero tax. This works for real estate. This works for stock. This works for businesses. You get this step up in basis for the heirs of the asset. So as you're passing it down to the next generation, they can effectively inherit the asset and pay zero capital gains rates. Now, they still got the $700,000 debt they got to clear out, but they'll sell the asset here and they'll get $300K on it. That $700K has to get paid off, but there's no tax at all on this. That $300K goes to them entirely tax-free. That is the die part of this. The key piece being, of course, the step up in basis of appreciated assets, which effectively wipes out any capital gains tax, which is the main tax that applies to investments. But it evaporates here when you pass away and your heirs inherit the asset. Now, the number one key to building wealth is accumulating assets that appreciate in value and can produce income. Because you don't have to work if you have assets that appreciate over time and produce income. That is the key. Stop selling your assets that can go up in value and that can produce income for you. Instead, consider the buy, borrow, die strategy here. Let's access that wealth and the appreciation. I want you to enjoy it, but stop selling the assets. It's not only a great way to keep building net worth and building wealth, it's also a great tax strategy because it keeps more money in your pocket. Now, for more tips on building wealth, saving taxes, protecting your assets, make sure you're subscribed to my channel. I'm Matt Sorensen. We'll see you next time.